At the end of last week, we had two very strong pieces of data coming out regarding the US economy. Firstly, we had the non-farm payrolls number, which indicated that there was the 243,000 jobs were created. That was well ahead of expectations at the time. And that was shortly followed by the ISM survey. This is the forward-looking survey for the non-manufacturing industry. And that indicated again that growth or optimism about the economy was running ahead of expectations. And those two bits of data, in effect, helped create quite a strongly fueled charge by the equity markets, which has broadly held through the rest of this week. And that's despite the fact that we continue to await a deal or some sort of resolution in Greece. It's been promised on numerous occasions during the week that we would see an agreement, but it's still not on the table. And what they're trying to do there is, in effect, get full party agreement to some measures of austerity that will be required before the release of between 130 and 145 billion of new funds, and certainly to help pay this impending bond redemption, which is due in the middle of March. So whilst this is a pressing issue, it feels that Greece has not been the main story of the week. It is that turning US economy that is helping equities move forward. So let's take a look at the charts. Take a look at the UK index here. This is the FTSE 100, and again you can see that strong charge of the end of last week, which carried on this week, and then for most of the week it's fair to say that the market has held ground at about 5,900. Indeed, one feature has been the sharp reduction in volatility of asset classes that we've experienced during the course of this week. We're looking at VIX levels of about 17, and in fact the true VIX level of the last sort of 5 days is probably more akin to 11. So it's been a week that's been experienced by sort of quite low volumes, and indeed quite low volatility. If we take a look at some of the features in Europe at the moment, one of the supportive features to the risk appetite at the moment is this continuation of yields declining in Italy. This chart here showing how the yields have continued to reduce. However, one noticeable feature for this week, which I've been highlighting, is that despite quite strong demand for Spanish bonds in the auctions, you can see those yields have really started to turn up again at the moment. It doesn't appear to be affecting sentiment at the moment, but I'm watching that one quite closely. Yields on Spanish are now back up to 5.34, and it's some speculation that we may indeed see some crossover there in the course of the next few days. So just one that has the potential to affect sentiment on a negative basis if we see a continuation of those Spanish yields moving higher. But whilst risk appetite remains positive, it does mean that we are beginning to see more traction about US economic growth, and that filters through in the commodities sector. This index is a sort of blend of commodities and oils and other energy assets, and you can see that whilst it's not running away at the moment, in fact I think the sort of fairly steady oil price is a factor here. We are seeing good demand into copper, and it's been aided by the fact, sentiment certainly, by the fact that Glencore is now trying to buy out the balance of Xstrata. The perception around is that the Glencore team are some of the smartest operators in commodities, and the fact that they are looking to buy out the balance of Xstrata at this stage should be very supportive to their view on commodity prices over the course of the next few years. So that's been a feature of this week. Currencies, well, it's still the story of the euro dollar at the moment in the main. You may recall at the end of the year there was reference to the record amount of short positions taken by hedge funds against the euro. Well, they must be hurting a little bit if those positions do remain open, because this squeeze higher of the euro at the moment, despite a lack of deal in Greece, is more because of the supportive trends that we're seeing with the US economy at the moment, and indeed for lower yields in some of those periphery debts. So the euro continuing to squeeze higher at the moment. feature. Now, turning to a couple of stocks I wanted to highlight for this week. One is SuperGroup. SuperGroup is a retail organisation that towards the beginning of January issued quite a strong trading update for its retail sales over the Christmas period, but they've had to update fairly quickly since then. It appears that during the course of January, retail sales at SuperGroup have declined, and declined quite markedly, reference to 3% downward growth to SuperGroup, and that caused the shares to drop by 20%. It doesn't look so noticeable in this chart, but a 20% decline there. We have seen other profit warnings from French connections, so that's one to keep an eye on. The January retail sales at the moment appear to be quite negative. What aspect that's going to have for the Bank of England with regards to their QE programme, which is anticipated to be increased from the current 275 billion by between 50 and 75 billion pounds at today's announcement. And the final one is a small company, but worth highlighting out of the Killik Special Situations offering, to show that some of these smaller companies are doing good things around the world. This is a company called Bango, and this company has already announced a deal with Amazon, and recently this week announced a deal with Facebook. So it's demonstrating that it can compete on the global stage. It is involved in mobile optimization payments. So as Facebook are coming to the market later this year with a $100 billion offering, much of that valuation is how they're going to be able to monetize the 800 million followers to Facebook, and mobile optimization payments are obviously pretty critical to that whole process, and having scoured the world, it looks like they've done a deal with Bango. So a small AIM stock, but moving sharply higher on that news.